Good morning, good afternoon, good evening to you all. Another Tax Talks. I was told it's the 14th today, and extremely happy to be with the team to present the latest. We had an important meeting yesterday of the Inclusive Framework, and we'll try to read out the documents for you to help you spot what you would like to find in these documents. You have our email address, send your questions. We have received a few questions and we'll be happy to take more, knowing that the presentation may last about 1 hour, but we are ready to extend for a few minutes to respond to questions. Introduction, the team with me today, Grace Perez-Navarro, my deputy, is participating for the first time, I think. Welcome, Grace. Matt Andrew, who is now in charge of transfer pricing and tax treaties in the team, will drive you mostly through the Pillar 1 thing. He will be assisted by Sophie Châtel, in charge of the tax treaty unit. And we are lucky to have Dr. Pros in Paris today, who will be the second pillar of this presentation. Agenda quickly, introduction done. We will go through the package agreed by the Inclusive Framework yesterday, released today at 10 a.m. French time, and we'll try to sketch out what the next steps could be. The meeting, well, here you have a picture. You can see that you have a number of people. I think we had more than 300 delegates, 360 from 122 jurisdictions. If you compare to the membership of 137, it means that not that many missed the trip to Paris, which shows the interest of all these countries on an equal footing, and they freely adopted the package yesterday. I would like to turn to Grace so that she reminds you of the background, what happened since the last webcast in particular, and then we'll move to the package. Grace, up to you.
Thank you, Pascal, and good afternoon, everyone. For those of you joining for the first time, the last time I was in a webcast was when we launched the BEPS package in 2015, and that is really the genesis of the work we're discussing today. Action 1 of the BEPS project dealt with the tax challenges of the digital economy, and that's what we're talking about today. Back in 2015, we basically parked the issue of the wider tax challenges. As a result of that, we have had increasing unilateral measures over the period of time between then and now. We've had more difficult and some might say unprincipled audits, with some tax administrations being increasingly frustrated with the outcomes that arise under the current international rules. We had said in the Action 1 report of 2015 that we would come back with a report to deal with these issues in 2020, but the G20 was rather frustrated with the lack of progress and the continuation of unilateral measures, and so they asked us to do an interim report to try to move ahead with this work and to come up with a consensus-based solution by 2020. So in January of last year, we published a policy note which set out 2 avenues to explore, which the Inclusive Framework agreed to explore on a without prejudice basis, looking at first nexus and profit allocation rules under what we call Pillar 1, and second, looking at what is known as the Global Anti-Base Erosion Proposal, which tries to ensure that a minimum level of taxation is paid by multinationals. And on top of that, we agreed to carry out an economic analysis and impact assessment to ensure that we could see what the impact was, because obviously for countries to make informed decisions, they need to know what the potential outcome of that might be. So that was in January. Then by May, we produced a program of work which further elaborated these proposals. Under Pillar 1, we had 3 competing proposals on how you might look at the issues of nexus and profit allocation. We recognized then that we could not continue this work and achieve our goal of reaching a consensus by 2020 without trying to come up with a common approach that was likely to achieve consensus. And so that is why in October of this year, we produced the unified approach under Pillar 1, which was published as a Secretariat proposal, meaning that it was not binding on any countries at that point in time, but really was our effort, our attempt to try to advance the discussions and narrow the options, which was consistent with what was outlined in the program of work. So we put that out, we had a public consultation, and now what we're going to present to you is the outcome of the discussion in the inclusive framework on BEPS on their views on this proposal. As Pascal will describe, there was endorsement of the unified approach as modified by the inclusive framework in the meeting over the last 2 days. And here in the slide you can see the different elements of the unified approach, where we have a proposal for a new nexus rule, profit allocation rules that provide for 3 different amounts, and the overarching element of this proposal is to ensure that we increase tax certainty. We have had a series of consultations on all of this. We had the consultation on the Pillar 1 proposal, the unified approach, in November. We followed that with a public consultation in December on Pillar 2, and you can see the vast interest that we have had from stakeholders through the numbers of submissions and participation. And in addition to that, we have also had a number of regional events to try and engage with countries and stakeholders locally. And that has been, I think, very effective in trying to inform the discussions that we just had over the last 2 days. Thank you.
Thanks, Grace. And let's move to the core of the discussion today, with the outcomes of the Inclusive Framework Plenary, which met the day before yesterday and yesterday. What has been agreed is a set of documents, namely 4 documents, even though they can be grouped in 3 main elements. The first one is a statement, political statement, a statement which conveys a political message to the world, which is the state of play of the discussion, the level of commitment, and what's next. Second, we had the inclusive framework agree an outline of the architecture of a unified approach under Pillar 1. And here, if we want to summarize, we would say that the unified approach was proposed by the Secretariat, was tabled by the Secretariat. It has been discussed at length over the past few months in October, November, December, and in January, the inclusive framework decided what to do with it. And they adopted an outline of an architecture which draws significantly on our approach, recommended approach, which itself drew on the 3 concurrent proposals which had been put on the table, as Grace reminded you of. And together with that, the other document which has become an annex of this outline is a revised program of work, so that under Pillar 1, so that in the coming months we can indeed develop this unified approach. Finally, the group welcomed a note on progress made by the working parties on Pillar 2, and it's part of the package because since the beginning, and beginning was almost last year, when the inclusive framework adopted a policy note, it's been agreed to explore 2 pillars, and we have this progress note on Pillar 2. Slightly different status to the extent that on Pillar 2 we didn't need to have a unified approach, to the extent that we had an architecture, we had some parameters, and they are being explored in accordance with the timeline. So what we suggest to do is to drive you through the documents. And it's not a verbatim, you can read by yourself, but we'll try to identify what we think is important, reflecting the discussion, or for Pillar 1, what would be the differences between the unified approach developed by the Secretariat and what was adopted yesterday. And going through the reading of the documents, we'll try to point the most important points. So, first paragraph, and the statement includes 7 paragraphs. It's a short document, a one-pager. The first paragraph states what we think is the most important, which is strong support of the inclusive framework members for reaching a multilateral agreement with respect to Pillar 1 and to Pillar 2. That's the verbatim of what you can find in the document, first sentence, and I think that's the main message. A number of people were wondering, well, is this process dying because of some recent developments? Is it going on? It is going on with strong support from the members, the 137 members, the 120 plus, which attended the meeting in Paris last week. Second, there is the recognition that the concurrent work on a without prejudice basis of the 2 pillars is taking place. The important word here is without prejudice. This means that nothing is agreed until everything is agreed. So we still work on a without prejudice basis. But if you combine that with a strong support expressed by the members, you can see that there is a direction of travel which has been fixed. And recognizing this concurrent work on the 2 pillars, they affirm their commitment to reach an agreement on a consensus-based solution by the end of 2020, which is in line with the G20 mandate. So 1, support for reaching the multilateral agreement. 2, a timeline which is respected. 3, without prejudice, recognizing the concurrent work on both pillars. Finally, there is agreement upon an outline of the architecture of the unified approach on Pillar 1 as the basis for the negotiation. So that's change of ownership from a Secretariat proposal. You now have a document which is the basis for the negotiation, and this document is agreed by the membership of the inclusive framework. And finally, a welcome on the progress developed by the working parties on the Pillar 2, which follows the outline of Pillar 2 in the program of work. So things are on track. The second paragraph starts focusing on Pillar 1. So the IF endorses the unified approach as the basis for the negotiation of the consensus-based solution. It's a proposed reallocation of taxing rights under Pillar 1, which is at stake, and it would require improved tax certainty. And there you have the 2 components of this Pillar 1 approach. On the one hand, reallocation of taxing rights through nexus and scope, and on the other hand, improved tax certainty. And what will be explored, again, this is not an agreement that everybody will be doing effective and binding dispute prevention and resolution mechanisms, but it's agreed by all the members that this needs to be developed so that at the end of the day, when the package is to be discussed and agreed, we have all the different bricks, all the different elements available. And finally, it is said that in the design and implementation of the solution, the inclusive framework acknowledges the need to minimize complexity. This is not just lip service. I think there is big concern in the business community on the complexity of the project. There is a big concern also from developing countries, emerging economies, developed economies. There is an agreement, I think, that if this goes on, it will have to minimize the complexity for all the companies as well as all the taxpayer. And I will turn to Grace for her to drive you through the rest of the text.
Thanks, Pascal. We're now moving to paragraph 3, which still is talking about Pillar 1. As Pascal has already said, clearly the work is not over, even though we have this strong support and agreement now on moving ahead with the unified approach as the framework for resolving the issues of nexus and profit allocation. So the IF members noted that there are many technical challenges that still have to be resolved before we get to a workable solution, and we'll be talking about those issues a little bit later. Also, there are important critical policy differences that remain to be resolved among countries. Countries currently still have different views on some key issues, and so that is acknowledged in this statement. In addition, the statement notes the December 3 letter sent to our Secretary General from Secretary of the Treasury Mnuchin, which reiterated the U.S. political support for a multilateral solution. So I think that was important, as Pascal hinted at earlier. There was some concern, I think, among people that this letter was suggesting that maybe this work wouldn't go forward, but in fact, it does express support for a multilateral solution and trying to find that here at the OECD. It did also make a reference to the fact that they have a proposal on implementing Pillar 1 on a safe harbor basis. And this was the first time that the Inclusive Framework had an opportunity to discuss this proposal since we received the letter, in the U.S. Explained its proposal, and members of the Inclusive Framework had an opportunity to comment on that. And many did express concerns about taking this forward on a safe harbor basis, as they are concerned that that would raise issues and difficulties from a technical perspective, that it would increase uncertainty rather than increase certainty, and it would fail to meet the objectives, the policy objectives of the overall project. We have noted in this statement, or rather the Inclusive Framework has noted, that although the final decision will only be taken after the other elements of the consensus-based solution have been agreed, that we will be including this in the work program to look at it and how it might work. So I think that was a quite important statement from the Inclusive Framework, now that they have had a chance to discuss this issue. Obviously, the resolution of this issue is going to be critical to reaching an overall consensus. There are a number of other issues as well. Oops, as we, sorry, I don't know if there's a slide missing, but this will be one of the big issues that will have to be resolved. Then in paragraph 4, the Inclusive Framework also recognized these other issues, and here you have them highlighted. One is the binding nature of dispute prevention and resolution mechanisms, and of the dispute resolution mechanisms under Amount C. We have had, and I think people heard at the public consultation, that there are countries, some developing countries, concerned about something like mandatory binding arbitration. And so what we have suggested is exploring other types of dispute resolution mechanisms that could achieve the same outcome, which is finality and certainty. And so we will continue to explore those issues, recognizing that at the moment we don't have consensus on exactly where that will land. Other countries have proposed the idea of digital differentiation in the treatment of highly digitalized activities as opposed to the wider consumer facing. So that is a big issue to discuss, and also the issue of regional segmentation, with some countries suggesting that there should be differences in profit allocation based on regional differences. And so these are just some of the issues. Obviously there are others, but these are some key issues that have been identified. We have noted the concerns also of some countries and businesses about the continued application and proliferation of digital service taxes. That is obviously one of the reasons why we are carrying out this project, to stop unilateral measures so that we can have a global consensus-based approach. So that's paragraph 4. We now turn to paragraph 5, which focuses on Pillar 2, which Dr. Prost will take us through later. Pillar 2, here, as Pascal said, we have a different type of document that is annexed to the statement. It is a progress report rather than a new approach, as you have in the case of the discussion on Pillar 1. Here, the Inclusive Framework welcomed the significant progress we have made on the technical design of the pillar. We've been able to do that because we did not have 3 competing proposals under Pillar 2 as we had under Pillar 1. Obviously, much more work needs to be done on that, and that is set out in the progress report. Then in paragraph 6, we talk about the economic analysis and impact assessment. As I said, this is critical to countries in helping them to decide their views on the final package, and they have welcomed the work we've done so far. They've asked us to strengthen the analysis and have expressed caution due to the data limitations that we have in this. Obviously, the ability of our economists and of economists in each of the countries to be able to make a good and reliable analysis depends on the data and also depends on the ultimate parameters of the 2 pillars. And so we don't have the final decisions on that, so that makes it quite challenging. We will be providing more detailed analysis on this before the end of March. Finally, paragraph 7 expresses the reaffirmation of the Inclusive Framework members to bridge all of these differences that I've just highlighted and to try to reach agreement on a consensus-based solution by the end of 2020. So that should be very good news for the G20, that this strong commitment remains among all 137 members of the Inclusive Framework. They note that the agreement will obviously depend on the further work, the technical details, the decisions on the different policy issues. And the next step in all of this, which is key, will be the next meeting of the plenary of the Inclusive Framework, which will take place on the 1st and 2nd of July in Berlin. And there we are intending to reach agreement on the key policy features of the solution, so that would enable countries to have a political agreement on the package. So with that, I will then turn it back over to my colleagues.
Thank you, Grace. So just turning to now the outline of the architecture of the unified approach. Just a couple of starting points from me. So Sophie and I will walk you through the outline of the architecture of the unified approach on Pillar 1. I'm now going to refer to the document just for the ease of reference as the outline. This document, in terms of background already provided, but important to note, has been drafted through with input from the public consultation process, and obviously directed and input provided from the Inclusive Framework and its steering group. So the next 2 slides really outline the structure of how the unified approach document is ordered. I'm not going to touch on now, obviously, the introduction and overview, but really sort of Sophie and I will really focus on the substantive sections of the document. And importantly, also focusing on where there have been changes, amendments and updates provided from the public consultation document, which was released in October 2019. And so you'll sort of see where the thinking and the drafting is really focused on to clarify issues under the unified approach. So let me just sort of focus first, noting that Section 3 is the new taxing right. So here we really deal with the issue of scope, which companies will be in scope potentially, and also the nexus of market jurisdictions to receive an allocation under Amount A. We then will go through the quantum of Amount A, how is it calculated, and the allocation process. 3.3 will talk about the elimination of double taxation, which is a really critical part of this of the outline of the unified approach and how it works, and its workability, and then we'll talk about the interactions between the three allocations, amount A, amount B, and amount C. We'll then move on to section 4, which specifically deals with amount B. And turning to the next slide, we'll then talk about section 5, tax certainty, dispute prevention and resolution, and as it relates to amount A first in 5.1, and then we'll move on to 5.2, which deals with tax certainty in relation to amounts B and amount C. Importantly, on section 6, we'll give a brief overview of the implementation and administration and the workability of the unified approach, which we'll cover in 6.1, and then talk about 6.2, the global safe harbour system. And lastly, we'll briefly touch on Annex A, which is the program of work. It's been already alluded to by Grace and Pascal, but just note the key features of that, so when you're reading it, you have some direction around that. So with that, I will turn over to Sophie to talk to you about scope and nexus of amount A.
Thank you, Matt. Yes, turning to scope and nexus, you will remember that in October when we discussed the unified approach, the key concept was the concept of consumer-facing business. You will also remember that that concept includes many of highly digitalized business models, for example, online research engine and social media platform were covered under that concept as well, but not all, and some business model were also not covered, and these were related more to the B2B transaction business model, and a large section, for example, of the cloud computing services were not covered under that concept. So what you will see in the unified approach that was agreed yesterday to explore with the inclusive framework is a concept that has two main categories of businesses that will be within the scope. So the first category of the business that we talk about is the automated digital service. These were, as mentioned, highly digitalized business model, but also cover, in these cases, a cloud computing service. So you'll see a little bit more details on that in the outline. The second category of businesses that are covered into that scope are those that are consumer-facing business. So again, you're familiar with that terminology. What I would like to highlight here is that there was an evolution in our thinking with respect to intermediate products and components. Largely, those will be considered out of scope of a consumer-facing business, with possible exception, and again, the outline discuss a little bit more about that. Nothing new, extractive commodity, largely support for those activities, those sectors to be out of scope. A development here is that recognition that, yes, financial service industry is largely not consumer-facing business, but a section is, and then more consideration will be developed in how to cover those services and consideration for exclusion. Similarly, international traffic sector has been highlighted as one sector that merits further consideration and possible exclusions. But it's not all companies that will be covered in the scope, even though they meet the definition of an automated digital service or consumer-facing business, only the large one. And this is where we come to the threshold. I'll highlight that we have an Annex B that explain a little bit the interaction of various thresholds. So we'll have a revenue threshold. We're talking here about possibility to use the CBC reporting threshold of 750 million euro. But additional threshold will be looked at, such as the aggregate in-scope revenue, or also the profitability of a certain segment. So that will be also contemplated to narrow the pool of companies within the scope. Turning to Nexus, what is not new here is we again rely on the principle that what we are trying to achieve here is to get a the company will have a nexus, M&E Group will have nexus if they have a significant and sustained engagement in the market. Again, this will largely be measured by looking at the local in-scope revenue threshold. Sustained, well, we'll look at a period of time. What is also considered is that we should commensurate this threshold with the size of the market to satisfy both large and smaller markets, with a possibility to have a minimum level of activities required to fall into the nexus rule. What is new, though, is, again, I mentioned 2 different categories of business will be in scope. For automated digital businesses, there's a recognition that those are carry on those activities, which what we called, and you'll remember those concept of scale without mass, right? And so what we are looking at here is that the revenue threshold in these cases should be the only test to establish a nexus. With the consumer-facing business, there's a recognition that if you are selling tangible goods, for example, you should not, the mere selling in a jurisdiction should not trigger by itself a new nexus rule. So therefore, we'll be looking at additional factors. Now, what is important in the outline is the fact that very importantly, we'll need to design rules for nexus that eliminate or to limit to a bare minimum any filing requirements and especially avoid spillover effect on other tax or even beyond tax. So a lot of you have supported in your public comments the idea of a one-stop shop that is in other areas of taxation, and we've heard you. We'll indeed look at those simplified approaches. So turning to Matt now for the quantum of amount A. Matt.
Thank you very much, Sophie. So now we turn to the calculation and allocation pieces of the unified approach, and in particular amount A. So in the public consultation document, which was issued in October 2019, we noted that the allocation of amount A was based on a formulaic approach. And this has not changed. This is the same as it's outlined in section 3.2. So I would bring your attention to some points around that as you read through it for your clarity. So the quantum of amount A is calculated based on a formula designed to identify the portion of residual profits allocated to market jurisdictions. And so that includes elements of the formula, which is a profitability threshold, and then an allocation threshold of the residual, which is retained in the allocating entity and then sent to the market jurisdictions. It's also important to note as well is that the allocation to the markets will be based on sales and specific allocation of sales which are specific to each of the market jurisdictions. So the points of clarification and what has changed in this paper is in relation to clarification that group consolidated financial accounts are an appropriate basis for the calculation. Profit before tax is the preferred measure to compute amount A residual, and the outline also affirms that loss carry forward rules will be developed in relation to amount A. Also, further technical work has been identified in section 3.2, notably segmentation, that is business line segmentation or regional segmentation may be required where you have in-scope and out-of-scope activities, for example. Also exploring whether the quantum of the residual income for amount A should be weighted differently for different business activities. Also, specific revenue sourcing rules will also be considered in situations where there is a lack of clarity or difficult to identify the end user or consumer. So this was an area where there was significant comment in public consultation, and so this obviously forms an important part of the program of work. Turning to elimination of double taxation, I really only want to make Three key points in relation to elimination of double taxation. This is in section 3.3 of the outline. So elimination of double taxation continues to be a key to the successful operation of the unified approach. There is further elaboration on this issue in the outline compared to the public consultation document, and that's in three specific areas. Identification of the taxpayer entities. The paper refers to measures of profitability to identify the allocating entities. The outline references the use of credit or exemption mechanisms in order to eliminate double taxation. And the outline also notes that corresponding adjustment method, transfer pricing method, may be difficult to apply in certain cases where there are no transactions between the allocating entity and the receiving entity. So the elimination of double taxation remains an important point, and again, is an important part of our program of work. Now turning to section 3.4, interactions between A and B. It is noted this was an area that attracted a lot of public comment through the public consultation process and the submissions associated with that process. Institutions, organisations are looking for clarity. What is A versus B versus C? We would note 2 points as you read through section 3.4. The first is that it is the view that there is no significant interactions between amounts A and B, and that's because amount A is an allocation of residual profit, whereas amount B is an allocation of routine profits associated with baseline marketing and distribution activities. Interactions between A and C are potentially identified, and examples are identified in amounts A and C. However, it is important to note that the section 3.4 notes that no double counting should give rise to double taxation, given the application of mechanisms to eliminate double taxation, which is in section 3.3. Now I'm turning to section 4. Section 4 refers to amount B. The architecture of amount B is very similar to what you saw in the public consultation document in October. So I'll only make a couple of key points in relation to this for your ease of reading. The first is that amount B is a fixed return based on the arm's length principle for baseline or routine marketing or distribution activities performed in the market jurisdiction. The fixed return would consider differences in regional and industry, and treaty changes will not be required to implement amount B. Again, further technical work is required in this particular area. The issue of profit level indicators, baseline activities, and fixed percentage agreed points, benchmarking studies have all been indicated as areas of questions and area of concern through the public consultation process. So again, that's been adopted into the program of work, which we'll refer to later. At this point, I'll turn back to Sophie to go through tax certainty.
Yes, the inclusive framework members have recognized that tax certainty is an essential element of the unified approach and is a fundamental part of the design of Pillar 1. How to achieve that certainty, we'll see that it could be different from amount A than from amount B and C, which involve more bilateral treaty or disputes. So you'll see that the section 5 is divided in two main, and I'll start with the dispute prevention and resolution on the amount A as a way to achieve that certainty. You'll remember amount A is going to be applied on a multilateral basis with potentially with the businesses in scope involving over 100 jurisdictions altogether with one assessment presented in front of them. So the agreement in the inclusive framework is that a new effective could be mandatory binding dispute prevention, and I emphasize the prevention element of that new mechanisms is required to implement amount A, but also exploring resolution mechanisms as well. For amount B and C, well, it's different. We are in a bilateral world. So Amount B will achieve tax certainty mainly by focusing or agreeing on using fixed rates of return on a baseline distribution and marketing activities. Amount C, however, is different. Again, Amount C involved dispute under the existing transfer pricing system. And there's different position, different policies. You have, on the one hand, countries that have adopted in their policy, and especially treaty policy, the arbitration, mandatory binding arbitration. And on the other hand, you have countries that do not have such policy. So as we're exploring a new system based on a multilateral aspect, but based on bilateral relationship, we have to explore how is there any possibility to bridge those gaps and see the need for developing innovative approaches to dispute resolution. Reaching an agreement on the breadth of the application of those new mechanisms will be key to achieving consensus in 2020. Also, enhancing existing MAP and domestic measures to resolve, prevent dispute is also an important part of that section in this agenda. Turning to implementation and administration, I would mention three main points under the general implementation aspect section. The first one is there's a recognition that implementing the unified approach will probably or necessarily involve the negotiation of a multilateral convention. The second point is that when we design the rule, we have to focus on minimizing the compliance and administrative costs, and that's important equally for government and for businesses, taxpayers. So the work will focus on simplifying the administration of the unified approach as a big part of the designs. The third point I wanted to make is it's recognized in the outline that as inclusive framework members agree to implement the unified approach and reach an agreement on its design, as part of this process, they will have at the same time a commitment to withdraw relevant unilateral action, and that will be part of the work that we'll be doing is to define which are those actions. Grace mentioned earlier the alternative global safe harbor approach, and that is also an alternative, an optional elective approach to the Pillar 1 work that we will explore as part of our program of work. The program of work is ambitious. We have a lot of technical work to advance. We are already full speed in identifying the key technical area. You have them on the slides here, but more fully developed in the program of work. And on that, I will turn to Akim to cover the Pillar 2 progress report.
Thank you, Sophie. And yes, Dr. Pross, otherwise known as me, will take you through Pillar 2. I think my colleagues from Pillar 1, like a Swiss train, exactly on time here. So I do have exceptionally some time for Pillar 2. I will take you through where we are. This is just a recap. Most of you will know this, but we have a nice chart that illustrates this, so we're going to use it again. This is the essence of the components that are part of the Pillar 2, otherwise known as the GLOBE proposal, as Grace has set out already in the introduction. There's 4 rule components of interlocking rules. If you wish, it's not a specific rule, it's an integrated system of rules. I'm going to talk about rule coordination towards the end. There is an income inclusion rule, you know that, drawing on CFC rules. There is a switchover rule that deactivates exemption situations in certain treaties. I'm going to talk about this for a moment. There is then an undertext payment rule that complements also the inclusion rule. And finally, there is a subject to tax rule, but that's not to suggest that any of these rules are more important than other rules as part of this package. So then let me tell you briefly through the timeline, where we are and where we're coming from. You recall that we approved at the Inclusive Framework a policy note in January 2019. Then we had a public consultation on Pillar 1 and Pillar 2 in February, March. We adopted a program of work in May. And in June, we started to work at the level of the Working Party. There is a lot of technical work that's ongoing, and the poor delegates were first exposed to 80 pages of detailed Secretariat reflections as early as June, and have been meeting a number of times, both in the composition of Working Party 11, for those that know our groups, and Working Party 1, as well as a subgroup that we have set up with particular experts in financial accounts and the relevance for Pillar 2. We've had a second public consultation in December of 2019, and thanks to all of you that participated in this public consultation. And then finally, as Pascal has indicated, as part of the package that was agreed by the Inclusive Framework yesterday, we also released the progress note on Pillar 2. Now, on this progress note, I think 3 brief points. It is brief, so you can actually read it. It's only 3-4 pages. The purpose of this note is also to record the progress. Where are we? What have we done, and what is still ahead? And then also importantly, and you'll see this as you read it, it reflects the views of the diverse membership of by now 137 members. And as Grace has indicated, we did not need to revise the program of work because the pillar proceeds on the basis of the agreed program of work that we agreed in May, and there were no competing proposals, so we did not need to adjust that. Noting at the same time that a number of the design elements are still under discussions, and there's particular differences in which way these design elements may evolve. So then, in a nutshell, I think this is what we're telling you on the next one. Where are we? What is the status of the work? We're making good technical progress on many aspects of the Pillar 2, but also significant work remains. There's constructive discussions, I think, from all, even different policy views. The technical people are hard at work to think about how the technical aspects could be overcome, how the best design options interact with other design options. There's a close coordination between the relevant working parties, in particular Working Party 11 and Working Party 1. And a subgroup, as we indicate here, that we have set up with particular expertise on financial accounting and what this might mean, given that that is being considered as the possible base for the income inclusion rule, and then also for the under-tax payment rule potentially. We had input from stakeholders in March and December in the public consultation. And again, this isn't, as Pascal has said, just lip service. We actually, in the Inclusive Framework, and that is in the progress note, actually acknowledges the valuable input from stakeholders. And we realize that some of these timelines are ambitious. I know that some of you have other terms, but it is ambitious, certainly. We had a public consultation on the 9th of December. It was even during a strike, just to test your dedication. But business was on time, and so was civil society. We are reading all the submissions, and they have been extremely helpful, and we will be able, hopefully, to prove this. But again, we want to stress that, and we fully recognize that sometimes our timelines are ambitious, as I say. Then perhaps just a word on the income inclusion rule, the under-tax payment rule. Many of these will not be new to you. I'm also going through the progress notes. You know that the top-up, it would be a top-up approach here, certainly in the income inclusion rule, to an agreed minimum rate, which is calculated as a fixed percentage. And as it also says in the program of work and in the progress note, just to recall, that feature would protect both the tax base of the parent jurisdiction, but also those of other jurisdictions. And that's certainly important to understand that the rule set here isn't so much conceived as giving revenue to a particular country, but we recognize that there are likely behavioral impacts of taxpayers and jurisdictions. So that if you look at this from a behavioral response side, and if you also reflect on some of the CFC rule, it will not be purely a function of rule order how the allocation of potential tax revenue implications and distributions will fall. The UTP rule here focuses on the denial deduction or an equivalent adjustment in relation to an intergroup payment, and as I said before, it complements the income inclusion rule. If you then turn to the next page, which I will do, Then we talk about the key design issues here that are under discussion, and again, you'll see them in a little more detail in the progress note. There's 3 things we can point out. One is the tax base, the second is a question of blending, and the final question is the question of carve-outs. And without taking too much time, I think there was strong support that was coming through also in the public consultation as a concept to use as a starting proposition for the tax base, the use of financial accounts. There was also a strong support, I think, broadly of using the accounting convention applicable in the parent jurisdiction. I think there was a strong support, in particular in the context of jurisdictional blending, I'll get to that in a moment, of mechanisms to address temporary differences, and much of the work is now focusing on what type of mechanism that might be, with different mechanism under discussion and potential combinations of different mechanisms that could perhaps be layered. There is a discussion on the adjustment for permanent differences, where there is, of course, the tension of trying to rely as much as possible on the unadjusted financial statements, but then also recognizing that certain adjustments need to be made. And it's a balancing act of accuracy, complexity, getting the right rule, but getting it at the lowest possible compliance cost. There's questions on blending. These options are still being considered with, not surprisingly, a focus on jurisdictional and global blending here. And then finally, there's questions on carve-outs, FHTP, you know what the program of work says. Substance carve-out, where clearly, and this is also reflected in the progress note, there is language in the program of work, but there is also an interest by a number of countries for substance carve-outs, and we will be discussing those as we go forward. Finally, I think on the side here, these issues are also relevant for the under-tax payment rule, but there's also other features that will be relevant for the under-tax payment rule. In particular, having a rule that is designed to limit complexity, compliance, and administration's costs, but at the same time is effective, but doesn't go from a situation of, if you wish, under-taxation to a situation of over-taxation, of a situation of taxation more than economic profit or double taxation. And there sometimes the interests also of tax administrations are in fact aligned with the interest of business, because neither side wants to have a rule that triggers high compliance cost or high complexity in potential audit. Then let me turn to the last couple of slides. Let me turn to the subject to tax rule, an important rule part of the package. That is a rule that is more designed with a sort of a bilateral treaty situation in mind, where one country may have ceded taxing rights on the expectation that there would be a certain level of taxation in the other country, and if turns out not to be the case, then potentially there is this subject to tax rule that would come in. So it is a rule that would subject a payment to withholding or other taxes at source and then deny the treaty benefits. We are looking at a number of different options of how this could be done, the issues that would be involved, with a focus on trying to make it as simple and targeted as we can. There's a number of considerations which we're now going through on what would be the scope of the payments, the design of the minimum tax rate test, and other key aspects. And there's also, as it also says in the program of work, an exploration. We're reflecting on the application of the STT, of the subject to tax rule, to unrelated parties, potentially in the case of interest and royalties. And then finally, just a word on the switchover rule. That, as you know, is a mechanism. It's designed to ensure that the income inclusion rule can also apply in situations where you have an otherwise exempt foreign branch because of a treaty obligation, and then removing that and turning on effectively a credit method if that income was subject to a low ETR. It's a more specific rule because it does contemplate a situation where it is the obligation in the treaty itself that causes the non-taxation of that low-taxed income. So then my last slide here, just to sum it up here, that's the last part, but not the least important, about rule coordination, simplification, thresholds, and international obligations. One, there is a clear understanding that here this situation should not lead to the contemporaneous applications of different rule sets. So we don't want to go from low or no taxation to double taxation. So there needs to be rule coordination among the different rules, and that needs to hold both in design but also in practice. There needs to be simplification measures that we are now going through in the various working parties about how do we do this at the lowest potential compliance cost. Linked to that, we're having discussions on threshold. Potentially, one could be, it's under discussion, the CBC 750 million threshold, and you will have heard considerations with respect to that also in Pillar 1. And then finally, compatibility with international obligations, treaty obligations, but if you are in the EU or the EEA, there may also be such implications. I think with this, I give it to Grace.
Thank you, Achim. I just wanted to very quickly highlight a few other things that the Inclusive Framework has been doing. We are very pleased that we'll finally be releasing the new chapter on financial transactions for the transfer pricing guidelines. This has been some of the outstanding work in the sense of we didn't complete it in 2015 with the rest of the BEPS package. It's also outstanding in that the final outcome, I think, is pretty good. So we will be providing that on the 11th of February. This work is the remaining work associated with Action 4, which deals with the use of interest deductions and other financial payments for base erosion and how to combat that, and also the actions 8 to 10 on ensuring that transfer pricing outcomes are consistent with value creation. Then on the 13th of February, we will have a webcast on the economic analysis and impact assessment that we have been helping countries with. You'll hear about the data we've been using, the methodology, et cetera. So that will be an opportunity for you to engage with our team that has been working on that. And then on the 17th of March, our St. Patrick's Day public consultation on the country-by-country reporting. You may recall that in the Action 13 report, there was a reference to having a review of certain aspects of the Action 13 country-by-country approach. So the types of information, should we have additional information or different information, the threshold, and other issues like that. So we will be issuing the public consultation document sometime next week. So you can look forward to reading that and ultimately participating in the public consultation. And then finally, we will be issuing the Action 6 report, the second annual report on the treaty abuse minimum standard. And I think what you'll see there is that it clearly shows that those countries that have signed and ratified the MLI have benefited in terms of fulfilling their commitment to Action 6 by having signed the multilateral and ratified it. So you can look forward to that in the coming weeks. And then we also have the latest peer reviews on dispute resolution under Action 14.
Thank you, Grace. You can see that beyond what is the most visible, which is the work on the digitalization of the economy, we have a few other work streams which keep us busy and which are of great importance. And there are many others which are not mentioned, the work on the firm on tax administration, the work on tax and development, which is completely mainstreamed in the team, and many others that at some point we should share with you. Just a few words of conclusion. You can see on this slide a timeline which may look a bit insane, but that's our timeline. We have some milestones, the meeting of the finance minister of the G20 in a few days in Riyadh, then the inclusive framework on the 1st and 2nd of July in Berlin, and the finance ministers of the G20 again, who should take stock of the progress in Berlin, and finally all these being brought to the attention of the G20 leaders in November, late November. And the goal is to reach agreement on the architecture of Pillar 1, the architecture of Pillar 2, solve the issue of the relationship between the two pillars in July, and seeking a final agreement by year-end. this is the timeline we are facing, and I have to say that it's extremely challenging. So we don't want to be too naive, too candid. We're presenting to you the progress which was made, and I think it is fair to say that probably many of you didn't think that there could be an agreement on substantial elements under Pillar 1 at this January meeting. Probably many of you thought that the whole process could be derailed by some of the proposals. And you can see, and these words are not drafted by the Secretariat, they are drafted by the member countries. And I can tell you that we had several rounds of comments on these documents, plus a final round of comment at the meeting, and we spent hours discussing this. Many countries, tens of countries, have commented, and they have taken ownership of that language, in particular on the statement, but also on the two other notes. So what I want to say is we're not too candid, and we realize how challenging this is. From a technical perspective, developing the right rules in such a short period of time is a big challenge. But beyond that, we have some of the political issues highlighted in the statement, which are there. And not to mention, but I do mention it, the safe harbor issue, which came late in the process and has surprised many countries. It's still there. It is identified as to relate to implementation. Decision is deferred until the rest of the pillar is developed. Work will be done there, but that's pretty challenging. So we just want to say the work is going on. The political support, the support by all members is here, and we believe that things will move fast, but we'll see whether we can reach an agreement, whether the members can reach an agreement or not. But to respond to one of the questions we have received, what is the plan B? And we do not have a plan B, or what I think the members can see, and many other observers can testify that what they see is indeed a big risk. It's a trade war based on tax disputes, and I'm not sure that many countries are eager to move into that direction. You could note that probably in the recent declarations by President Trump and President Macron, and the exchange later on by the finance ministers of France and the US. So you can see that there are many things at stake. It's very high profile, it's extremely challenging, but the alternative looks really bleak, which is why we are within that pretty challenging timeline that we have to cope with. The work is going on, and as usual, we will draw on the comments from the civil society, from businesses, and I would say even more importantly, from the sovereign jurisdictions, which are all members of the inclusive framework. So we count on you to help us move this forward. With that, we're already beyond the timeline, but as I indicated, we can extend by a few minutes to respond to a couple of questions. One of the questions we have received is about the division between automated digital services and consumer-facing businesses, and the risk to threaten the risk to move to some form of ring fencing, which in the report back in 2015 was considered as impossible. What you have is what members have agreed, and all the members agreed that we should identify two elements. And I think Sophie was pretty clear, identifying the fact that in the Secretariat proposal, the unified approach, digital services were included under the broader heading of consumer-facing businesses. The inclusive framework thought, after a long discussion, that it would be better to separate out these two components of one scope. So there is one scope with two main components. And it's interesting to say that on the automated digital businesses, there is an extension to what was initially in the unified approach proposed by the Secretariat. Cloud services are explicitly mentioned, for instance. So risks of ring fencing, not exactly, because that's broader, and the rationale that you can find in the document explains why we're talking about consumer-facing and digital services. So I invite you to read this section. We have a few more questions on carry forward of losses, and so all this will be examined in the program of work. You have seen the 11 or so blocks for further work, which are annexed in the Pillar 1 note. So I encourage you to look at them, and for sure there will be further interaction. The last word is to echo what Grace said about the impact assessment. The work has moved on. We do have assessment of the impact on countries, and countries are working on the data. But we also have an impact assessment on growth, on investment. Is this reallocation of taxing rights, amount A, is it having or would it have an impact on the global economy? This is extremely important, and work is carried out. If you want to know more, watch the webcast, which will be done in a few days on that topic. I would probably share with you all, or with a number of you, the frustration that this data is not yet completely published. The reason for that is not retention of information by the Secretariat, but rather nervousness by the countries which really want to get it right before it goes public. So they feel constrained on that field. We encourage them to be transparent because we think that this information should be out, and we are hopeful that in the coming weeks, months, this will be out for sure before the key decisions be made. On that note, and not having further questions, I would like to thank the team, not only for the webcast, but for the crazy past weeks where we had to work round the clock to be able to supply the right documents for the members of the Inclusive Framework. I would like to thank the members of the Inclusive Framework who traveled to Paris massively, which shows the interest, which shows that it's not a game with just a few players or just the G20 countries, but really all the countries. And we had brilliant interventions by a number of small countries, OECD countries, or developing economies, or small investment hubs. They're all here, all involved and pretty active. So thanks to all. And last and not least, thank you all for being again at this webcast. We appreciate your fidélité, as we say in French, and we wish to see you soon with further news. Thank you. Bye-bye.